Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player.
Good day, all. Ira Epstein of Linn Associates with your financial market wrap-up, and I've got it right now. In the two prior videos, I said February 6th. It's February 7th, which is Wednesday, 2018, and we're getting into the 4:40 time frame, which means these boards are all going to clear on me very soon. You know, today I did a interview with Liz Claman on Fox TV. And the one thing I was asked, said, Ira, you'd been still bullish the market, are you? And I think it took guts. I said, nope. I think there's a time where you pick up your chips and you walk away from the table. And that's basically where I think you're at and why. On the stock indices, whenever you get this much volatility, every day, 500, 700 points, volatility typically doesn't come at market bottoms. It comes in at market tops. At least that's been my charting experience. When you're very quiet, markets like to take off. Remember, you hear the adage, never sell a really quiet market? I don't know if you've heard that, but it is an adage around the industry. Well, you almost have the opposite. When you get this volatile, you're looking for prices to give ground. And that's what I think's going here. When I was on the show, you were up 200 in the Dow. You were higher in a number of the indices. And I just said, no, I think you put your money away. I can tell you that I haven't put out trade recommendations this week for my paid subscribers. It's time to back off, let the volatility slow down. So what's going on? If we take a look at the weekly chart, this is how you finished up last week. This was Friday. And when we did that report, I said, if we correct, could we be getting back towards the 18-week moving average of closes? Well, doesn't take much now. That number was 2664. You hit a low so far of 2668, and it looks like the low of the week is already 2529. So the answer is you're there for all purposes. Okay, I can live with all that. When I take a look at a daily bar chart, just the swings, you tell me what's going on, because it's pretty wild if you ask me. I don't know how you live through these events with a normal stop. You can't. You've gone from 28.78 to 25.29 in basically a week and a half, okay? That is a 300-point drop in the S&P. And if you think you make that low and you just go back to those highs, God bless you. I know that we now have a battle on our hands between the Senate passing another budget. I don't think it's the budget. I think it's a budget that gets us into March. I don't believe they've solved the Dreamers problem. And I know Nancy Pelosi is waiting with bated breath for that bill to come into the House of Representatives, where she is trying to make sure it doesn't pass. I don't recall the last time she stood up 5 hours and talked at the podium. And they're saying on TV it wasn't a filibuster. I can understand why, because there's nothing in her hands to pass. I guess that's it. But 5 hours of constant talking? Wow. Rand Paul did that, do you remember? That was, I guess, a filibuster. This is different. Come on. But you've got the market doing its play here. When we put on moving averages, you can see that you slid through the 100-day average, followed through, came back, and what had been support before, will it act that way again, along with what? The Bollinger Band. Now, if you'll notice, today's break magically stopped at the Bollinger Band. And the reason isn't that it's so magical, it's that so many people watch it. And I explained to you as chartists one time a while back, I used to love the old Merrill Lynch commercials of the bulls running down the street. In fact, the Chicago Bulls, when you go to a game, were using that type of ad for themselves, you know, as the bulls come charging. However, the reason is that if you stand in the way of what the herd understands, you get hurt. And in this case, these two levels are acting as support. Now, that doesn't mean tonight something happens with our budget and things go haywire. I couldn't begin to tell you. But there's nothing on this chart that is screaming to me, hey, become a buyer in the market. I can tell you momentum is flattened out. I guess that's good. We all need a break here. The market is paying attention to those numbers. The bias is down. But to try to step in the way of that, let the ranges tighten up where you have a shot at it. When we come to the NASDAQ, same thing. We had the play where you got under the Bollinger Band on Monday. The next spot could be the 100-day average. It was. You got over the upper Bollinger Band. You followed through to a higher number today, and by the end of the day, you retested that Bollinger Band and you closed right by it. When we come to the Dow, I don't think you're going to make me do this on every one, but this is a downtrend. This isn't like the others. Lower highs, lower lows, you're back into the band, and sellers were waiting for this market. I was looking up here. It's to say, gee, what if I put out a sell recommendation for clients? And then I looked at the risk. Doesn't look like a lot, right? But at $5 a point, you've got roughly 500 points or $2,500 of risk. I'd rather pick up the chips, as I said, and go have some drinks than risk $2,500. In looking at the Russell, it's like the Dow. Lower highs, lower lows. Momentum is flattened out. Let these markets get their feet under them before you do anything. And I realize the thing on TV is, well, have your wish list ready and buy individual stocks. I agree. If valuations get shrunk instead of 20, 25 times earnings and they get down enough, sure, I don't think the general economy has changed. I think that this is a sign of higher interest rates and the market's getting used to them. And even though when we had the big break the other day, you got back towards 2.7 on the 10-year, you're back to 2.85. As soon as this market feels that it can do it, it's adding for the Fed what real rates are in the marketplace. In the VIX, you got up to 50. I was talking, when I did my Fox show, I was with Rick Santelli of CNBC, and we were talking on the floor. And we both agreed that this number, we had been talking about it, this VIX was a trap waiting to be sprung on people. And it sprang it. And as you saw, some of the funds that have these crazy inverse ETFs, the 3-to-1 leverage, they're blowing up on people. You went up to 50. You're back into the 20s already. This is what happens when volatility comes back into a market. And some of these funds, I don't even know why retail traders are in them. It's just a bad place to be. Take a look at TLT. This is a ETF of generally interest rates. It's heavily weighted, I believe, into the 10 years, but it's still in a very big downtrend. The market is still saying, with the momentum, it's trying to go lower. There's no point in fighting that. And that's what you're fighting in the market. You're fighting a watershed event of higher interest rates now happening. And the markets have to adjust. And as they adjust, they do it once. And after that adjustment, it's out of the way. Let it adjust. Same in the bonds. They're coming down. Oversold. 10-year notes. Oversold, but failing at the 18-day average of closes. And the dollar index, well, you know, for the longest period of time, we heard that the Fed was raising interest rates, and all the dollar did is fall. That game has shifted. I don't know that it's the watershed event or not, because at the end of the day, the dollar will face headwinds as interest rates slow our economy down, as they climb. Remember, Europe's not at this point yet. The Brits aren't at this point. I don't count them as the EU. Japan has no interest in wanting to raise rates very quick, and I don't see China doing an awful lot. So as I'm looking at all this, yes, we can get further of a rally, but have the real fundamentals changed all that dramatically? For the time being, they've adjusted. That might be the right word. When you go to the eurocurrency, it's not trending. You had a higher high, lower low, and now it's letting go off of this. Amazing. It took all this time for it to do it. Where's the talk that Europe might be tightening? If you looked at today's data out of the EU, they're increasing their projections on their growth. Germany, they got together, and it looks as though Ms. Merkel will get a coalition government. But it's about interest rates in the U.S. right now, and the market changed gears on people. British pound. Brexit's fully back in, and the market's looking at the problems. It's oversold, coming down. Could it make a run into the 137? You do realize when we were up here at the beginning of the year, you, like me, probably read a lot of people's projections for the year. I'm reading it's going to 150 in the pound. I'm looking at where it's at, and it just come from down here, and I'm going, you know something? The bulls get more bullish at tops. The bears get more bearish at bottoms. Got to be careful. And that's pretty much what we've done. We got to be careful with where we're at. I want these markets to become more normal in their trade than anything. In the Japanese yen, no trend. You got a higher high, a lower low, flat momentum. It's like begging markets to do nothing. Now, a nice bounce off the lows for Bitcoin under $6,000 back into the 8,200 level. You may not like it, but there are traders that are going to say they bought it down there and they made 33% on their money like that. You can't argue with that. Are Bitcoins going away? I doubt it. Look at this sideways action. Remember what we talked about? You always look for this as to where the next trend's going to come from. This is screaming at you. Keep looking at me. In the situation of the Brent versus WTI, first, we saw a big build today in the EIA number. Bearish, bearish, bearish. Can't get away from the fact that more rigs are out there. We're producing more oil. The game, and I mentioned it yesterday, may have bottomed out in this $3 area because I think that something in that zone, and I don't know this, is what it would cost to ship a barrel from America to Asia. And at some point, we know it's not free. You build in that cost, and the two stop fighting each other. They travel more, if you will, sideways, and I think that's pretty much what's going on here at this point. I think $6 was too high, and I think the market's saying that, and I don't know this, that maybe 3 is a number that makes sense with resistance back up at the 4 level. In the crude, lower highs, lower lows. Let's take today's action out of the market. You have a downtrend that's trying to break out to the downside. The risk is large. Even if you could sell it at 69, you got a $1,000 risk on the Brent no matter what you do. You closed under the lower Bollinger Band 2 days in a row. You tried to get back over it today, and you fell apart after the EIA number and higher interest rates actually happen in the market. You're oversold. I wish I could tell you where the market will bottom. I can tell you that at this point, that $71 mark is a trade top, and I can tell you in WTI, the $66 mark is a trade top. Now the question is, how low does it go in that? Both are in downtrends. What about gasoline? Well, it's obvious to me that if the market wants to reach further, the next big support number is the 100-day average at 174 in a downtrend. Natural gas, riding the lower Bollinger Band, but oversold, unlike some of these other markets. It's down to its support level at this point. So that's about all you can say. What's putting this market down? Mild weather. So we take a look at it and we try to figure out what to do. And I today decided to write a gold report. And I haven't written one, obviously. It's early in 2018, but I didn't really write one too often last year. I thought it time to do so. And if you'd like to get a copy of it, you can go to these different sites to either call us to get it or sign up for one of our offers to get it. We don't post this on our website. You can only get it from me via an email sent you. And I didn't include the seasonal charts. I certainly included, though, price counts, weekly, daily, and I give you what I think is going to be a pretty good revelation for you. So if you'd like to see it, I'd love to put it in your hands. You can also click up here if you see this icon on YouTube, and it'll bring you to our forums. Fill that out. Our new Investors Kit always gets this to you for sure. I'm Ira Epstein. Thanks for watching, and I'll see you tomorrow.